Stéphane Monier is Head of Investment for the European Private Bank of Lombard Odier. He has changed the approach to asset allocation for private clients and now uses a risk-based approach. Stéphane, good afternoon and welcome to Geneva.
Good afternoon.
Stéphane, the world has changed. Markets are much more volatile, which implies greater losses. Can you come back on the last few years and particularly the correlation between asset classes?
What we have observed over the last decades is that financial crises have been greater in terms of importance and impact on the market, and you're absolutely right that correlation between various asset classes have been increasing. What we have also observed is that if you take a very long financial history, let's say 200 years, and you count the number of financial crises that happened during this period, you have more than 40 financial crises over the last 200 years, which is an average of one financial crisis every 5 or 6 years. So now, if we look at today's situation, we are in 2014, 6 years after the last financial crisis. So you want to have your client portfolio prepared for the next potential crisis. And this is why we need to prepare our client portfolios for more volatility in the market. And this is why we are bringing this new approach, the risk-based approach, for our private clients.
So this risk-based approach you have tried and tested on your institutional clients, particularly pension funds. How does it work?
You're absolutely right. Actually, we started using this method of managing money for our own pension fund. This method was developed in 2008-2009 as our own pension fund had experienced some, I would say, not so good performance at the beginning of the financial crisis. Our partners at Lombard Odier asked us to find a better way of managing this pension fund, ensuring a decent return while protecting the value of the portfolio on the downside. This is when we developed the risk-based approach. After a few years, we realized that this methodology was delivering exactly the same performance as we were expecting. So we generalized this approach and we proposed it to all our institutional clients, whether pension fund, insurance company, or sovereign wealth fund. And in 2013, myself, I transferred from the institutional side to the private bank, and we thought that this method could be very useful also for our own private clients. So I was asked to deliver vehicles that will allow our private clients to invest in such a technology which is innovative.
But how does it work? What are the principles?
There are three main principles. The first principle is about protecting the capital, and I will come back to that in more detail. The second principle is about diversification, and the third principle is about selecting managers that can outperform in bull and bear markets. So the first principle, it's a little bit like the Hippocratic oath for a doctor. You know, when you want to become a doctor, you are asked not to harm your patients. Well, I think we should have the same in portfolio management. When you manage a client portfolio, the first rule should be not to try not to lose any money for that client. And this is very important in the current context because we are living in a world of low yield and high equity market valuation. So if you start on the basis that you have 100 Swiss francs, and let's say you are experiencing a big drawdown with a big market crisis, maybe you have only 50 Swiss francs left, which means that you have a negative performance of 50%. To go back to the original level, to 100 Swiss francs, you need to deliver a performance of plus 100%. In the current environment, unfortunately, it will take you a very, very long time to double your capital. So that's why it is very important for us to determine what is the risk tolerance of our clients and have an investment process that strictly adhere to their tolerance for loss, and that's what we do with the risk-based approach. The second element has to do with diversification. And we have made some economic research, and we found it that over the long run, economies experience three phases in the economic cycle. 40% of the time, economies are accelerating in terms of growth. 40% of the time, they are decelerating, and 20% of the time, they are experiencing inflation shock, like in the 70s. And what we have also observed is that certain asset classes are performing better in certain environments. Typically, equities, whether developed or emerging, are performing very well when there is growth. Bonds, whether sovereign bonds or corporate bonds, are performing very well when the economy is decelerating. And commodities are performing well whether when there is growth or when there is an inflation shock. So our approach has been to build a portfolio that will deliver return consistently over the full economic cycle. Hence, we have decided to equal the contribution of the various asset class to the economic cycle, meaning that we wanted to have 40% of equity for when the economy grows, so 20% of developed equities, 20% of emerging equities. We wanted to have 40% of allocation in bonds in terms of risk, for 20% in sovereign bond, 20% in corporate bonds. And then we wanted to have 20% allocation in commodities. But here I want to stress that I'm talking in risk terms, not in capital.
Okay.
And this translated in very different capital allocation. And this is actually what you can see on the chart here, which represent the allocation to the 5 risk factors on the chart on the left, where you have 20% exposure in terms of risk to each of the asset classes, the blue one being the sovereign bonds. You can see in terms of capital on the chart on the right that the allocation to fixed income has varied through time between 70% and 30%. So this was based on the fact that the risk of sovereign bonds had increased during this period. What also I find interesting about this chart is it shows you that this is a very dynamic asset allocation approach. You can see on the chart on the right that we have experienced 2 crises in the recent years. A crisis in 2011, which was the crisis of the euro, and then a crisis in 2013 that was the crisis of tapering. And in both instances, the portfolio was dynamically readjusted by a factor of more than 60% over one day.
And what are the results of this approach? How does it show in terms of performance or volatility and other indicators?
So to answer your question as far as the performance is concerned, you can see on this chart the performance of the strategy in the dark blue, and you can see that over time this strategy, when compared to a traditional strategy, has been delivering a performance which is quite similar, 7% versus 7.2%. However, the volatility associated with this performance is about 2/3 of the volatility associated with a traditional approach. In this case, 6.8 versus 4.4 for our Vantage approach. And when you make the ratio of unit of return per unit of risk, obviously this risk-based approach has a much better Sharpe ratio than the balanced approach, 1.5 versus 0.9.
Stéphane, thank you very much for joining us today, and thank you very much for the details about the risk-based approach.
Thank you for having me.